Picture a smoky New York bar in the 1950s. Benjamin Graham sits hunched over a crumpled notebook, dissecting stocks with a surgeon's precision. Around him, Wall Street's noise fades into a whisper. What if I told you that from this obsession came a blueprint for beating the market, one followed and reinvented by the likes of Warren Buffett and John Templeton? Stick around because these money masters aren't just rich, they're the architects of investing itself. Let's start with Benjamin Graham, the father of value investing. His secret, it wasn't glamorous, it was raw, gritty discipline and a math trick with a human heartbeat. In 1934, Graham was buying stocks trading far below their book value companies other investors dumped in panic. He called this cushion the margin of safety. When a stock's market price dipped beneath its intrinsic worth by a wide margin, he'd pounce. This simple yet radical idea saved investors during the Great Depression and remains Warren Buffett's North Star. Imagine a batter in baseball. They don't just swing wildly. Their stance is balanced and ready. Graham's margin of safety is that sturdy stance in investing, protecting you if the pitch swings wildly off course. It shields against errors in calculating value, unexpected market crashes, or even plain bad luck. It's investing's version of a safety net woven tight but flexible. The payoff? Investors ignoring this principle often chase shiny new stocks or hot tips, blowing their capital when the market shifts. But those firm on this principle generate consistent, surprisingly calm profits even during chaos. Buffett once remarked that it's better to be approximately right than precisely wrong, a wisdom echoing Graham's stubborn focus on safety. Fast forward to Omaha, 1965. Young Warren Buffett is eyeballing Berkshire Hathaway, a struggling textile mill most saw decline. Warren, he saw a grand experiment in patient investing that changed how we see compounding. Buffett bought Berkshire Hathaway stocks when the company was drowning in debt and poor management. Rather than flipping the stock quickly, he held steady, buying more shares as he found undervalued gems. Slowly, he turned this textile company into a holding powerhouse controlling insurance, railroads, and more. His patience wasn't luck, it was a strategy honed by decades of mentoring under Graham. Picture running a marathon, not a sprint. Buffett's investing isn't about fast wins but steady, long-haul endurance. Holding on to great companies lets profits compound, earnings reinvested to generate more earnings, like a snowball rolling downhill, gathering mass and momentum, faster and faster as it moves. The transformation is spectacular, starting with just a few $1,000s and decades later building a fortune worth over $100 billion. Buffett's secret sauce? Letting time multiply value rather than chasing short-term market noise. It's a masterclass in patience, rewarding those willing to wait and watch their wealth grow silently but powerfully. Now let's check out Philip Fisher. Less about numbers, more about gossip and human insight. His secret weapon? A detective's curiosity that uncovered the DNA of great growth stocks. Philip Fisher famously spent months calling suppliers, customers, even competitors to get the lowdown on companies before buying shares. In 1958, he chased Motorola, not because its numbers dazzled, but because his scuttlebutt revealed breakthrough technology and visionary leadership. This unconventional research paid off. Motorola later dominated the electronics market. Imagine being a reporter on a major scoop, every detail matters. Fisher's investing method mirrored that, digging beneath quarterly reports, unearthing the why behind growth. Unlike relying on data alone, his approach gives context and color, revealing strengths invisible on balance sheets. Investors who emulate Fisher gain an edge. They spot companies with durable competitive advantages and visionary management before Wall Street catches on. It's the difference between owning a fad and owning the future, turning conversations into millions. Remember that smoky bar in the 50s where Graham sketched out a new way to invest? Every master in this book started with a simple but powerful habit, looking beyond the obvious, thinking differently, and holding steady when others panic. Try this before your next investment. Ask yourself, what's my margin of safety here? Could I wait 10 years for this to pay off? Have I dug deep enough? It's not magic, it's mastery. Subscribe for more book summaries like this one.